Okay, guys, it kind of works like this. When you're working with your broker, and I'll show you on the next slide exactly how everything works, but just want to give you a definition over some terminology that you're going to have to keep in your back pocket. When you're talking to your broker or when you're online trading, there are going to be certain different orders that you're going to have to place to let your broker know what you're trying to do. All right, so you have these different orders here, and you have market order, you have limit order, day orders, good to cancel orders, stop limit orders, stop loss. I mean, all this may sound confusing now, but I will try my best to just kind of like make it as simple as possible, because even though it may sound complex, it's not really all that difficult once you understand what each of these orders are for. Okay, so I'm gonna go over a little a little overview just to kind of give you a general idea how it works. All right. So what happens is, let's say for instance, let's say this is a chart right here. All right, we're gonna say this is a chart, and I'll be teaching you guys about charts down the road, next couple slides. But let's say this is a trend right here, and let's say it goes down a little bit, goes down, goes up. All right, like this. All right, let's say this is a trend. Let's say this is let's call this Apple chart. We call this the Apple chart. All right. Yeah. All right. Cool. We call this Apple. All right. Let's say that the price of Apple right now, just hypothetically thinking, let's say that right now the price is going for $400 up here. Down here, we're going to say the price is, just for example purposes only, $300. Right. So this is a price chart. The top of this chart is $400 and the bottom of this chart is $300. So pretty much how it works, guys, when you're talking to your broker, or if you're online, you probably won't be talking to he or she on the phone. All this is done electronically on your computer by a click of a button. All right, it's something called a market order. Now, a market order is an order that an investor makes through a broker or broker service to buy or sell an investment immediately at the best available current price. Now what happens is, let's say that Apple right now is trading for $375, for example. Right? It's trading right now for $375. When you put a market order in, you're telling your broker that right now at this minute I want to buy Apple at $375. All right, so if it's trading somewhere around here, 375, if it's trading somewhere around here, when you put your order in to your broker, you're telling them, he or she, that I want to buy it whatever the market price is right now. I want to buy it. And as a new investor, I'm going to encourage you not to ever use a market order. Okay. Let's just say a limit order. Now, a limit order is placing an order with a broker to buy or sell a set of numbers of shares at a specific price. Now, this would be the orders that you guys would be using, I would say probably 99.99% of the time. All right, it's either going to be this one or the day order. We'll get to the day order next. All right, now what happens is the limit order, you're telling your broker, yes, I know if you're on the buying side of this trade, if you are the buyer, all right, if you're on the buying side of this trade, what you're going to do is you're going to tell your broker that I want to buy this stock when it hits, let's say 355. All right, 355. What you're doing when you're talking to your broker through your computer, you put a limit order in. You're saying, I know that the market price of the stock is going at 375, but I want to put it in. I want to get it cheaper. I want to get it in at 355. So you put a limit order in saying I'm limiting uh, the price that I want to put in, all right, that I want to buy this stock for. All right, so that's pretty much what you're doing. You're just telling your broker that I want to buy this particular stock at a certain price. All right, and the day order is pretty much saying that you want to buy this stock at a certain price today. Now the market opens up at 9:30 in the morning and it closes at 4 p.m. all right, Eastern Standard Time. So what happens is when you put your order in that you want to buy Apple, let's say at 355, if it doesn't hit, if this stock right here, let's say Apple is trading somewhere down here somewhere. Let's say Apple is trading somewhere around here in the middle. If it doesn't hit 355 or whatever, something like that. If it doesn't hit 355, let's say 355 was here at this point here. Let's say 355 was here. But right now it's trading, let's say, well, see if it's trading here. Let's say if it hit here or whatever. Come back down at 355, right? It's the 375 now. You want to come down at 355. All right. You're telling your broker that you want to buy this stock at 355 when it hits 355 sometime today. All right. So that's what a day order is. It's between 9:30 and 4:30 before the market close. I want to buy this stock at 355. Now, if it doesn't hit 355, I'm out of this trade. All right, that's pretty much what you're telling your broker. You're out of this trade sometime today if it doesn't hit the price I want. All right. Now, a good to cancel order. What do you think that means? All right, good to cancel means that I am going to buy this stock at a certain price until I cancel my order. You know, you can literally stretch these orders out a couple of months. You can say, I want to buy Apple at 355 now until what's today's date? The 27th of February. You can say I want to buy Apple at 355 anytime between now and let's say March the 19th or March the 20th, something like that. So you can actually put an order in to your broker saying that you want to buy a specific stock now until whatever date you tell he or she that you want to get out of this trade. So you can have total control of this right here. Now, a lot of people use good to cancel orders, okay, when they are selling their stock. All right. So if you are in your stock long, this means that you're holding your stock a couple of months down the road, and you want to sell your stock or buy your stock at a certain price. You can put it in for a long time, or whatever day or time you can put it in. You can actually talk to your order and say, yes, I want to buy this stock at a specific price, but I wanted to, when it gets to that price, if it gets to that price now until the day I tell you that I want to get in that trade or I want to get out of that trade. Depends on which side of the fence you on as a buyer or a seller, okay? So that's a good to cancel order. And then you have a stop limit order. Now, I really don't like this order here because what happens is if the market opens up, let's say the market opens up at 9:30, okay? You put an order on the table that you want to buy this stock at, let's say, 355, all right? You want to buy Apple at 355, all right, but the market gapped down. The market gapped down when it opened up, it was at 325, all right? So the market gapped down because of the aftermarket. We'll talk about aftermarket and pre-market later, but let's say the next day it gapped down. When the market opened up at 9:30, it started at 325. Well, you put an order in that you wanted to buy Apple at 355, right? Stock limited. What happens is this stock, your order will still be on her table because it never hit 355. So what happened is this stock have to come all the way back up to hit 355 to get you out of this order. All right, so that's the stop limit order. Okay, so I would not encourage any of you guys to use stop limits, because just in case you want to hold this stock over a couple days and it might gap down on you, or it may go haywire on you. You're still in this trade getting beat up. Okay, so don't use this one. All right. A stop loss. A stop loss and a stop limit. Sometimes investors get these two mixed up. And pretty much stop loss is saying that, let's go back to our scenario when I was talking about the stop limit. Pretty much it's telling you that, okay, I want to get in this trade. Let's say you want to get in this trade at, let's say right now you want to get in this trade at $353, right? Well, if this trade goes down to let's say the trade goes down to 345, you can put an order in. Let's say you want to go to the supermarket, or you going on vacation, or you want to go shopping, you want to go to the mall. You can put an order in on your computer to your broker saying, all right, I just bought this stock at $353, but if it ever get anything lower than $345, get me out of this trade. Okay, I want to get out of this trade. Anything lower than $345, I want to get out of this trade. All right, it's called stop loss. This is how you save your losses, guys. So you will be using this order here just in case the stock go the other way. You're looking at your charts, and you're looking at all your indicators, and everything looks like the stock is going to go a specific way, but it ends up going the wrong way. You will be putting in these stop orders here to save your profits, or to save your losses, should I say? Because if you don't put your stop orders in, you guys can get killed and get wiped out of the game. All right. So I pretty much just wanted to show you guys all these different orders. Now, on the next slide, I'm going to show you exactly how to place an order with your broker.